Hey, what's up, guys? Back for another video. This time I'm going to get into common stock in total detail, total in-depth, because I said maybe I would go ahead and make another video. Maybe I will go ahead and make a video that details common stock because I touched it in preferred stock, but let's go ahead and just dive right in. It's going to be short, simple, sweet, to the point. So basically, when a lot of you go and invest and you don't know what you're doing as a retail investor in the market, you say, well, let me invest in a stock. Okay, let me get, I don't know, FedEx, Amazon. Let me just go ahead and buy something. You're investing in common stock. See, 99% of the time, I'm just making that up, but let's just say 99% of the time for an analogy, you are going to invest in common stock. Now, if you do your research due diligence, then you go invest in bonds or treasury bonds or invest in preferred stock. But the main time, that somebody is going to invest in the market, they're investing in common stock. So common stock. So you're basically saying, okay, take me into detail. What is it? So as a common stock shareholder, you are a shareholder of a company. You own part of the company. Because for a company to even be profitable or have some type of mission or value, they need investors. They need shareholders. People to say, well, this is working. People to say, well, I'm investing my money into you. The main goal of a corporate company is to maximize shareholders' value. We learned that fundamentals of finance. The main goal of a company is to maximize shareholders' value. So how do you do that? Having good free cash flows. Now, that's a lot of terminology that you probably say, well, I don't want to hear that right now. Okay, but your free cash flows, which are cash flows that are readily available to distribute to all investors, including preferred, common, debt holders, etc., after making necessary investments in operating capital. So besides that being the point, common stock, you have a shareholder's right to vote there. So you're probably saying, well, I don't care about voting. Why would I care? As long as the company's making me money, as long as my returns are going high, I don't care. Well, cool. So I get done with this in a minute. I just want to make sure people understand that, hey, this is something that's fundamental. So let's say that you love a company so much and you want to be a voter. You want to say, I want to appoint some people to the board of directors. Now, remember, as a common stock shareholder, you cannot vote for senior officials or officers. The board does. But you can vote for people on the board. So if you see somebody that's trustworthy and say, wow, that person has a track record of having good financials, knows how to run a company, great leadership skills, I trust them to make the right decisions to appoint people that can make me the highest return for as a shareholder. So you can vote for the board of directors. That's your voting rights. And there's two parts to voting. So you can vote in person. You attend a corporate meeting, and a corporate meeting, probably get an email or something about that. You can attend that. Or by proxy, you can use the absentee ballot. And there's two types of voting. You have regular and you have block. So regular / statutory voting is one vote per share per director. So it says you may cast one vote per share either for or against candidates for the board. So you're saying, okay, simpler terms. So let's say you have 100 shares of common stock when 3 directors are up for election. So you own 100 shares of common stock for 3 corporate directors that are up for election. Regular voting, 100 times 3, because that is one vote per share for or against each candidate for the board. So 3 candidates. So you could just do 100 votes for director 1, 100 for number 2, 100 for number 3. One vote per one share, either for or against each candidate. So however many shares you got times the number of candidates. And you can spread that for the board. Most beneficial to large stockholders, and it's most commonly used because the more shares they have, the more votes that go in. Now, cumulative / block voting. One vote per share times number of directors being voted on. So you can either cast your votes as a block for one candidate or divide into many as desired. So if you have that 100 shares of common stock for 3 directors, you can just say all 300. I don't like the director 1, I don't like director 3. Director 2 gets all 300 shares. You can do that with block voting. Mostly beneficial to minority stockholders because the smaller the block votes, because obviously they don't hold a lot of shares, but the more small the block votes, the more shares that can go up. So what I'm trying to say is the minority can eventually be the majority in a way. If you have all the little blocks that chain together, all the votes that chain together that are small, you get one big block. So that can help minority shareholders. So also one note for regulatory is that you can abstain from voting, but votes cannot be given to others. So therefore, you can say, I don't want to vote at all. Cool. But you cannot give votes to anybody else. So you cannot say, oh, well, I got 100 votes. Nah, I don't care. I want to give it to another person. You can't do that. It's your right, your shares. You can do that for your own self. And I want to go to the order of assets again. I know I discussed this in the last video. So when I was saying about who gets paid out if a company goes insolvent, if a company bankrupts, dissolves, etc. So if a company is going out of business and it's like, okay, we got to pay off everything. Taxes are number one. Secured debt is number two. Unsecured debt is number three. Preferred stock, then common stock. That's the order it goes in from top to bottom. So you owe taxes, you got to pay those taxes out first. Otherwise, the IRS will come after you. Secured debt is generally bonds that are backed by assets. So asset-backed bonds, like I said, debt holders. Secured debt and unsecured debt, which is general creditors. But regardless, the debt holders get paid second after taxes, and then comes preferred, and then comes common stockholders. Remember, as a common stockholder, you are not entitled to receive dividends. I cannot stress this enough. So many people say, they declare a dividend. Why didn't I get one? You are not entitled to receive one. Preferred stockholders have where they must get paid first. I said it last year. They must get paid first before you. So therefore, like I said, you guys get paid last, but you're not entitled. You cannot vote for senior management. You cannot vote for officers, but you can vote for the board of directors who appoints those people in senior management. They vote for them. So if you can vote for somebody favorable on the board of directors for yourself that you say, I want them to get this board of directors position, then they can vote for somebody that you may like as well. So remember, vote for the board, they vote for you. And that's how it goes. And another thing I want to get into before I close out for common stock, remember, common stock is just basic. You're a shareholder, you have rights. It generally has the best hedge against inflation historically during inflationary periods because it may go down a lot, but it also rebounds with the market. And the greatest potential for long-term capital appreciation. Here's the thing. When people get preferred stock, they're just saying, I kind of want a dividend, something a little bit stable. And as I said last video, preferred stock, less capital appreciation than common stock. See, it's more volatile with common stock. But the thing is, more volatility, you have a higher risk, but you also have a chance for higher reward. So, therefore, common stock is best for long-term capital appreciation. And I just want to get into some positives and negatives right quick of things that may or will affect common stock. So, let's get into the bad side. The bad thing is higher taxes. You obviously, when you sell it, you're like, man, I don't want to pay a lot of tax on this. So, the higher the tax, the worse it's going to be for you for your overall result. Rising rates, decreases in GDP, high unemployment. So, let's just say we're in recession. What is going to happen to the stock market? It's going to tank. So let's say everything's not going good with the economy. It's going to tank. But everything's going good with the economy. Low unemployment, high GDP, low taxes, low rates. Everything's going smooth. It's going to go up. And also, common stock is never callable. Remember, bonds are. They can be issued as callable. So the main overall thing I'm trying to tell you guys that when you buy a share of common stock or regular stock, you have the chance for highest capital appreciation. So you have to hold it for long term. You hold it for a year or less, it's short-term capital gains tax. You're going to get taxed more on it because the fundamental thing about stock is it's made to be held for a long time to get you more money over time. But some people are so greedy, or some people day trade. I'm not going to knock anybody that's day trading because a lot of people are great at it. I'm just saying a lot of people will take their profits, and that's good, taking profits. But at the same time, you have to understand if you are going to take your profits a year or less, you will pay short-term capital gains. So be ready to shell out a lot more money for short-term capital gains. Long-term capital gains, a year or more, then you'll be good to go. You will pay a lesser capital gains tax on that. And besides, you're holding it for its fundamental purpose, for you to generate more and more income from the stock over time, so that way it builds your portfolio up, and that way you can retire with it. I guess that's really the fundamental thing about when you're buying stock. It's for you to invest in things so that with the money you have in there makes you more money, and then you can retire with that or take it out for it. It's something that you might need help with. So that's pretty much it for common stock, guys. Thank you for watching. I don't know what next video is going to be about. Be a surprise. But once again, thanks for watching. That's common stock. That's the basis of it. And if you guys want me to do another one, somebody just let me know. So thanks for watching. See you next time.